debt. Of course, the neutral level of interest rate, it's very, very low. And because we have high debt, what does high debt to our economies? We have low R star, 0.45. We have low fiscal multiplier. And these two things, they basically demonstrates why people in Britain, they believe there was austerity and this, that, and the other. No, it's because doing quantitative easing, it fills up the banks with bank reserves. And then they have another constraining factor, is the financial friction. So that monetary policy into the private sector, the monetary policy transmission mechanism is not that smooth. There is a friction. So where even if the Bank of England cuts interest rate, the cost of borrowing for SMEs, it remains quite higher. The wedge, the financial wedge, it's wide. And so it's costly to take a financing terms from a bank to open a business. That's and to be profitable. That's the crucial thing. But here we have low R star, low fiscal multiplier. So what that means is that whenever you have an economy that it's working more or less, it's not a good idea. It's not a good idea to have a pro-cyclical fiscal policy, because the fiscal policy, the fiscal expenditure, it has a very low multiplier effect. So what it happens is that in an economy that is working properly, my idea, you have a low fiscal multiplier, you are adding to the high stock of debt, you have a very poor outcome of GDP, 0.25%, right, for every 1% of borrowing. And then what happens? That down the line, if you are in a crisis, then you have a low R star, low fiscal multiplier, you have added up a lot of debt because you have a pro-cyclical fiscal policy in, let's say, good times or in normal times. And then when the shit hits the fan, then you are in a recession, then you want to add even more debt, add more debt to already the high debt that you have. So my message is that pro-cyclical fiscal policy, or fiscal policy in general, just throwing money, it does not heal the pressure points of the UK economy. It does not repair the car. There are some other structural facts, which are monetary policy. We have inertia in monetary policy, which is not bad. What is the major constraining factor is the financial friction factor, which constrains monetary policy.